In this chapter, we've laid the foundation for their existing three categories of approaches to valuation. And the focus here is value in use, that is, in financial markets. We assume certain presuppositions that result in a well-functioning market. There's the market comparables approach, the discount factor adjusted approach. I suspect most people listening to this material have been exposed to those two. Some may not have been exposed to the category cash flow adjusted approach, and we'll go into this in great detail. Before we get there, let's focus on the market comparables approach. And recall we posed the question, how would you value a house? Well, one approach is the present value of rental income. You estimate the expected rental income over the course of several years, and then you estimate the appropriate discount rate. This is going to become known as the discount factor adjusted approach. Here, we're going to focus on the primary way that homes are appraised. We're going to identify, quote, similar homes and then make adjustments. And there are many other methods to valuing a home. The market comparables approach, where we focus here, Dewing noted that when several services or commodities satisfy a human want equally well, the value of each one of them is determined not by the sacrifice necessary to obtain each, but rather by the sacrifice necessary to obtain the one most easily available, which may be substituted for any one of the others. Specifically, when you're out shopping for a particular product, you don't ask yourself, what is the cost of producing that product? What you ask is, how can I acquire this product at the lowest price if they're comparable? And so two investments that result in the same future cash flows for sure ought to have the same current value. And that's the argument made here. Shares of common stocks traded on two exchanges ought to have the same price. Capitalizing on mispricing of this nature is called arbitrage, specifically static arbitrage. It doesn't require dynamic trading, something we'll look at when we get to the cash flow adjusted approach to valuation. The market comparables approach can be summarized very simply as simply the sum of the proportion of wealth invested in a particular instrument times the price of that instrument added up. Or mathematically, you can think of the value of some ith security is simply the sum of the number of shares that you own times the price of each share, not including the particular one that you're valuing. And so the beauty of this approach is there's no subjective items. There's no discount rate required, risk adjusted or not. However, the downside is the future distribution of outcomes assumed based on individual subjective probability beliefs or any other beliefs is not required. And so there is no distributional assumptions required here. You simply take the price of a comparable portfolio and you get the value. The key assumptions is that there exists a set of securities that produce the future cash flows in each state identical to the security being valued, even states that are currently unimaginable. Trading costs and other market frictions are assumed to be minimal. Short selling is allowed in order to permit the static arbitrage to be effective. The justification, we assume a well-defined state space that we discussed before. If, in fact, every single cash flow can be replicated by some investment in a set of other instruments in the absence of static arbitrage, that requires the current price of instrument I to equal to the sum of the proportion invested in each of the other individual securities. To give you an example, just to make this very tangible, consider futures options put call parity. If you're new to options, this may be a little bit difficult to understand, but just bear with me. Basically, there are four markets involved here. There's the call option market, there's the put option market, there's a futures contract that's involved somehow, and then there's financing, borrowing and lending. And basically the assertion is going to be, given any three of these instruments, I can produce the fourth, but based on the market comparables approach. And without going into great detail, consider the following trading strategy. If I sell a call, lend or borrow this dollar amount, whatever that is. If I buy a put, the net position is basically a short forward contract. And again, this is probably new to some people. This particular future cash flow, if you'll notice, has the same mathematical structure. It turns out if I go long a forward contract, if you'll notice, this mathematical structure is identical except for the sign. So this FTT cancels with that. Basically everything at expiration, regardless of whether the futures price is below the strike price or the futures price is above the strike price, also known as the exercise price, the future cash flow is zero. Well, what is the fair value of a portfolio that gets me zero for sure? Well, the three question marks, it has to be zero. If the three question marks are positive, then I've invested in four instruments. It generated a positive cash flow today with absolutely no risk in the future, and that is known as arbitrage. Interestingly, if the three question marks are negative, I will just do the reverse trade. That is, buy the call, sell the put, short the forward, and borrow or lend as the math requires, and I'll convert that negative to positive. And so this is basically a well-known approach known as static arbitrage, and this is an illustration of four different instruments. Given any three, you can compute the value of the fourth. An alternative cash flow table in this particular case is if we assume that we do the reverse trade that I just walked through, excuse me, in this case I buy the call, borrow or lend, sell the put, and again that will be positive by assumption. So table 2.2 will be positive by assumption if table 2.1 is negative. So if this three question marks are negative, I'm going to do table 2.2. If the three question marks are positive, I'll do table 2.1 set of transactions. And so just by way of numerical example, in the text there's an example given, and the way this is designed is to generate a 1 cent cash flow. Because this forward contract is at the money, there is no borrowing and lending. Basically, if I sell the 53-cent call, buy the 52-cent call, go long the forward contract, I generate zero for sure, and I put a penny in my pocket today. And you think, well, I'm not sure what's so impressive about putting a penny in my pocket today. Well, you do this a million times, it becomes interesting. And this is basically how much of financial markets operates. They operate within the market comparables approach in an effort to drive out mispricing through arbitrage. So some of the insights from market comparables approach: transaction cost assumptions are critical. If it's extremely expensive to trade, then there's reasons to believe that this approach might not hold real well. Notice that there are no assumptions regarding the future behavior of the underlying. The stochastic process of the underlying might be normally distributed or log normally distributed or asymmetric t-distribution, all kinds of strange possible distributions. All of that doesn't matter if I'm able to value based on the market comparables approach. Also notice that I didn't make any assumptions on whether the investor is risk averse or risk seeking or what their level of risk aversion is. There is no intermediate trading required. If somebody has strong beliefs on direction of the underlying, that may influence the spot price, but will have no influence on the derivative due to arbitrage. And so if everybody thinks a particular piece of this transaction, for example, if they think the forward price is too low, And so in that case, they would bid up the forward price. Well, that bidding up of the forward price, this number here, will cause the equilibrium call price to also change. And so this is what's known as partial equilibrium. We make no assumptions about whether any of these instruments are in general equilibrium. All we care about is the relationship between these four different instruments and how they relate to each other. Again, with this structure, you're able to value any one of these instruments, assuming that you have the fair value of the other three. And so in summary, for market comparables analysis, static replication of future cash flows is assumed. No risk information is provided in this methodology, so you can't use market comparables analysis, market comparables approach to do any analysis on the risk exposure of some portfolio. It's based on the law of one price. That is, if the future cash flows are all the same, the two instruments ought to have the same price. This is widely applied in, for example, by law, the mutual funds trade at net asset value. Well, that assumes a market comparables approach. The value of your portfolio is often thought of in the context of this approach. And there are many derivative instruments that are valued based on the market comparables approach. And so this is the first of three categories of approaches to valuation. In the next part of the video series, we'll turn to cash flow adjusted approach. And so we'll see you at the next video session.